And some of the world's top mutual fund CEOs are converging here in Washington, D.C. for the annual meeting, the 55th, of the Fund Industries Trade Group, the investment company institute. Its members manage assets of more than $13.6 trillion in the U.S. alone, and they answer to about 90 million shareholders, many of whom are just like you. Greg Johnson is the current chair of ICI, and he's perhaps best known as the president and CEO of Franklin Templeton. Mr. Johnson, welcome. Good to see you again.
Thank you, Tyler. Good to
How's
hear.
business?
Business is good. It's been
Money's coming in.
Strong first quarter, and we hope we can keep that rolling.
Are you seeing any change in the mix of fund flows? More into equities, less into bonds, or what?
Well, I think we were pleased to see that equities had a positive quarter, and that's been against the trend for active managers here over the last couple of years. But fixed income had another huge quarter, so it wasn't one at the expense of the other. I think I think what we've seen is after the sequester, more money moving back into the market, also some tax changes at year end. So January was a record month at the expense of some money funds, money that's been parked and then moved into equities and fixed income.
Are you having to swallow some of the expenses on money funds as so many other companies are doing?
We are, but for us it's a very small part.
It's a very small part of your mix. I want to play a soundbite from Lloyd Blankfein earlier today, because one of the comments or discussion points here this week is the weight of regulation on business generally, and most especially on the financial services business. So let's listen to Lloyd Blankfein earlier today.
There's uncertainty now, but I don't think spectacularly more than other periods that I've grown into now. But the recent history is really what's getting everybody nervous.
Mr. Blankfein basically had a Rafael Nadal serve that he could have smashed and said regulation is worse, but he said, yeah, it's there, but we just deal with it. Is that what you see?
Well, I think like any CEO, he's very careful about his words when he's in public, and regulation, after the financial crisis, Dodd-Frank, and obviously he's very involved in many of the different rules that have to be written. So there's less new legislation coming, but there's lots of new rules being written. So it's very active from that perspective. And I think some of the backlog, we're already 3 years past Dodd-Frank coming to life. That backlog has put a lot of pressure on many of the different regulatory bodies to get the rulemaking out in time, and the good news is I think they're being very thoughtful about the changes, because there are unintended consequences to many of these rules.
He talked about the Boca rule, and he basically said that. He said well-intentioned, but the unintended consequences are really the detail here. Another thing he talked about was the level of risk aversion in the investment business and in American business generally. Let's listen to what he said there, and I want to get your reaction to that as well.
People are nervous about taking risks. There's a huge consequence and fallout with getting things wrong. Nobody agrees on the price of anything. We have a situation where debt is very cheap, and yet nobody is borrowing to invest in their own businesses. Given where you can borrow debt, does that mean that people think they can't get a return out of their own businesses higher than their cost of funding and their cost of money? It seems unlikely, but that's where we are today.
I think what he was really driving at in part there was the idea that the financial crisis had left such deep scars, that the cost of getting something wrong was so intense that there's a risk aversion that is lingering even today. Is that how you see it?
Well, I think that's true. I mean, the financial crisis had a huge impact, and I think for many companies, when they don't see growth prospects, they tend to move towards cost cutting. And even though balance sheets are healthier than ever, if we don't think that incremental investment is going to bring growth, and a lot of that's just based on how you feel about the economy, that money's not going to be spent. So you can have liquidity, you can have easy access to loans and a healthy balance sheet, but if you don't think that dollar is going to earn more than sitting on your balance sheet, then you're hesitant to do that. So, I think it really comes to how the consumer feels about the direction of the country, and that's a lot of big issues.
One of the things I learned about your business today is how global it is. You have offices in 30 countries. You sell in, 150 or 180 countries around the world. Is that where the growth is for you, and is that where the growth is going to be for the mutual fund business?
Well, I think for Franklin Templeton, we've been focused on building our business outside of the United States for 25 years. And like any business, we knew your household penetration will hit saturation at some point here in the States, and that pretty much has happened, and it's a big business and a good business. but we wanted to make sure we were in places where middle classes were emerging. And I think for Franklin, having Templeton, having the network of offices, the research, and the relationships, we were able to build out distribution, build out local asset managers in many of these countries that are just growing much faster. Consumers are being created, middle classes are growing, and that's translating to mutual fund investors.
You said earlier that 30% of your assets are out of the U.S., but 50% of your flows are. That really sums it all up. Greg Johnson, thank you very much for being with us.
Thank you, Tyler.
Good to see you again.
Appreciate it.